what we're seeing right now a little bit deeper, get some analysis now from Andrew Kelvin, the Chief Canada Strategist at TD Securities. Andrew, it looks like we pretty much got the ballpark of what we expected for the hit that we took in the second quarter, but this June number, it's giving me at least a little bit of hope about the handoff.
I mean, I think the June number is the more important of the two numbers, frankly. We know the damage done in April. We know the damage done in March, which obviously impacted the handoff into Q2. June is what tells us how much of the growth that we lost through March and through April has been recovered. And the smaller the mountain we have to climb, the better it is for the economy ultimately.
Now, we do have a flash estimate, which StatsCan has been giving us throughout the pandemic to say, the early numbers, but we want to give you a look ahead to what we're seeing out there in the economy. So they say for the month of July, their flash estimate was that we saw an expansion of 3%. So not quite as strong as June, but does this tell us that we're starting to slow down, or are we still on the right path?
We were always going to be slowing down after June. June was always going to be the highest growth month just by the nature of the reopening process. A 3% number in June, if we realize that, that's actually quite a bit better than certainly I'd expected. And it's the sort of thing that probably puts your estimates for GDP in 2020 somewhere in the sort of -6 area. Again, quite a bit better than I had actually penciled in. So that's a very pleasant surprise for me.
Okay, so then we have some momentum heading into the third quarter. Of course, the worry has been out there that after historic pullback, which we are getting confirmation now the second quarter of nearly 40%, we would see that sharp rebound. But then after the low-hanging fruit was picked, there'd be a long road ahead. As you look at these numbers, I can't imagine the road still isn't long, but is it a little bit more optimistic about getting back to where we had been before the pandemic?
The way I would contrast this, because we'll get back to where we were before the pandemic eventually, no matter what you were to see this month. Like, we will get there. This will end. I'd contrast the Canadian experience with the U.S. experience, where we have recovered more than half our jobs lost. We've now recovered, roughly half the GDP lost. I think it is a fair bit better than some of our peers, and I think it speaks to the fact that we've seen the virus, run maybe a little bit less rampant, and we've seen very, very significant targeted fiscal stimulus.
Andrew, as I take a look at some of the details here for the second quarter, they're talking about housing investment, and of course, we are looking backward now, and there was a sharp decline in housing investment attributable to physical distancing. Of course, they say ownership transfer costs, renovations down, new construction. But as the summer continues to grind on, we know that the largest market in Canada has been super hot. We've seen starts from coast to coast to coast explode as well. It doesn't make people comfortable when we put all of our eggs in the housing basket, but it does seem to be an area of strength, at least for the third quarter.
Absolutely. I think there's one lesson we can draw from the last few once-in-a-lifetime recessions we've had in the last 13 years. Canadians tend to respond very strongly to very low interest rates, and we have never seen interest rates this low. So I don't think it's entirely surprising to see housing as something that was going to be leading us out of the recession. I think it is surprising the magnitude to which we've seen housing come back. I think if you're to take a straw poll of economists in March or April, no one was going to tell you we were looking at this housing market. But I do think it makes sense that housing is one of the more responsive indicators coming out of the recession. And we just hope we see business investment follow suit eventually.
Yeah, when we talk about business investment, but also household savings. So they say corporate earnings did fall in the quarter, but our household savings actually rose for the quarter, more than 10%, an increase in household disposable income. Seems like a strange thing to happen during an economic shutdown and a recession, but of course, we're talking about the government support programs, the CERB. So now we head into a new phase of that as well, trying to get people off the CERB over into the EI system. Is that another area where we have to sort of keep careful attention on, that transition is smooth and that people aren't left out of it?
Well, absolutely. We are always coming off of a very large fiscal stimulus package. The risk is always going to be that you run into a fiscal cliff at the end of it. This was a big discussion point in the United States, a decade ago or so. The fiscal cliff in the Canadian context would be if the CERB were to just up and disappear, which is why it's going to be really important for the economy that we do transition to the CERB in September. Just because, as you know, if you take away benefits from the people who still need those benefits, because fewer people need them today, but there is, the unemployment rate is still well north of 10%. That is something we will need to make sure we continue to gradually wean the economy off of transfer support versus, having the economy quit cold turkey, as it were.
When I do see numbers like this with household savings on the rise, it was good that CERB was able to keep people afloat through all of this. But then it also makes me think about the economic recovery being contingent to a large part on the consumer. We saw that in the last financial crisis, that it was the consumer. Will part of this recovery too being a key part of it be people feeling confident about spending their money? We can understand why they put it aside in the early days of the pandemic. We didn't know what was going to happen. Is that the hope here, that people will begin to spend again? And we have seen some strong numbers in retail.
That is the hope. In short term, that's the hope, I should emphasize. One of the reasons we did see the savings rate rise, it wasn't just all the transfers coming in from government. It was also the fact that people had less things to spend their money on. A lot of entertainment services weren't being provided. People were maybe reluctant to go out and shop. These travel all but dried up, these sorts of things. In the short term, we do need to look for consumption to be a driver of the recovery. Just because households tend to make decisions on somewhat shorter time frames than businesses. A lot of these structural issues around the oil patch are not resolved by the post-pandemic recovery. When we get into the post-recovery phase, when we start talking about 2022 and 2023 and 2024, we are going to be a scenario where we get back to this issue with Canadian households being perhaps overextended, with perhaps incomes not increasing to the same extent consumption growth has. And we are going to have the additional tailwind of population growth will slow in 2020 and 2021 most likely, which should impact the sort of aggregate level of consumption in the economy once we get back to your sort of so-called steady state. So, in the short term, yeah, consumption is really important. In the longer term, we are going to get back to this issue where the consumer starts to need to pull back a little bit.
Of course, we've had assurances from the government, and we've had assurances from our central bank as well that they will remain accommodative. Is this key too? When I think about the financial crisis, and I guess in the early innings, of course, fiscal policy, monetary policy seemed to be working side by side. And then I think as the decade wore on, there was some criticism that the fiscal side just pulled back and said, it's all up to you, central banks. I mean, it seems at this point we're not going down the same road that we went through before. They seem to be working together.
I think we're going down the opposite road. Central banks are essentially saying it's all over to you, fiscal policy, and that's not a criticism. Monetary policy has limited capacity to stimulate with a shock like this. Like central banks, they will tell you they are not out of bullets. They can always do more. The Bank of Canada can always buy more bonds, right? There's nothing stopping them from that. But at these extremely low levels of interest rate, the sort of stimulus you can get from a central bank tends to be pretty marginal. I think the experience of negative interest rates has not been positive. So that's not something that expected in Canada. The bank's been, I think, very, very clear. They don't expect to see negative interest rates in Canada. So really the only lever left that you can pull is fiscal policy. I think what's interesting in Canada is we sort of transition from talking about fiscal policy as a tool to help stimulate the economy as something to help achieve maybe broader societal impacts. A lot of the rhetoric coming out of Ottawa has to do with things like inequality and fairness, whereas if you go back to April, it was all about, getting money in people's pockets, getting money spent, keeping people, fed, housed, all these things. So, fiscal policy is going to keep being the dominant driver for, I guess, policy intervention in Canada, more than monetary policy will. Bank of Canada's probably got a very boring couple of years ahead of them. But on the fiscal side, it does sound like there is a fair bit more spending coming down the pipe.